Hey, what's going on everyone? Thanks for tuning back in, and if you're new, you already know what to do. Make sure you hit that like button and subscribe button so that way you can check out weekly posts on personal wealth management and market insights. My name is Ash, certified financial planner, bringing you the knowledge, perspective, and resources from my world to help you live a better financial life. Today's video is on taxes, more specifically how your investments are taxed in your brokerage account. And in case you didn't know, your brokerage account, aka non-retirement accounts, are taxed every year. So I'll break down the conversation into some of the common taxable events you may see and the potential tax rates that may apply to you. So to kick things off, the most common types of taxable events in your brokerage account are the accumulation of interest, dividends, and capital gains. Starting off with interest. Interest is generated by cash that is sitting in your brokerage account, and this is taxed at ordinary income tax rates. In other words, it is subject to whatever federal bracket you fall under, and also state bracket if that applies to you. Here's a quick glance on what those federal brackets look like. The link for these brackets are in the description below. Next up are dividends. Dividends are paid out periodically by some companies as a thank you for being a shareholder. And whether you reinvest those dividends or receive them as cash, they are taxed anywhere between 0 to 20%. And there's a range because it depends on what tax bracket you're in. For the full income ranges to see where you would fall into, there is a link in the description below. And lastly, and most importantly, capital gains. This results when you buy a stock and sell at a higher price. And the key word there is sell. If you buy a stock at $30 and the price keeps going up and up and up and you never sell, you will never be taxed capital gains. Capital gains tax only occurs when you sell the stock that you own. That is very, very important to remember. Let me give you an example. Now, let's say, for example, you bought a stock at $30 and you want to sell it now because it's grown to $70. Well, depending on how long you held that stock, that's going to determine how much taxes you owe. This is what we call a holding period. And depending on that holding period, you will either be taxed short-term or long-term capital gains tax. Let me break it down. If you held the stock for less than 1 year, that will be classified as a short-term capital gain. Short-term capital gain is taxed at ordinary income rates. So remember this chart from earlier? You can be charged as high as 37% if you're in the top bracket. If you are, that $40 gain on that stock that you bought, the tax liability on that will be approximately $15. But what if you kept it longer than a year? If you do, that will then be classified as a long-term capital gain. Long-term capital gain rates are taxed anywhere between 0 to 20%. And there's a range on that as well, and it's dependent on what federal bracket you fall under. But just at a glimpse, you can see just how favorable long-term capital gain tax rates are. In this example, if someone was in the top bracket and they held it to have it be long-term capital gains, their tax liability would drop considerably. You can see the tax liability pretty much being cut in half. One last thing to note when it comes to taxes on your investment accounts is that there is no tax withholding, which means that any dividends, interest, and capital gains that you have is given to you gross in real time as that transaction is executed. So basically, taxes are not taken out at that time. Your brokerage company, however, does keep a tally of all the taxable events that take place in your account. They do this via a Form 1099. This is basically a tax form that your brokerage company generates every single year. So you don't necessarily have to keep track of all the taxable events that took place in your account. Well, that just about does it for part 1 of this video, and I hope this gave you some better insight on how your investments are taxed and the differences between short-term and long-term capital gains. If this was helpful, please be sure to hit that like button and also be sure to share with those that you think might find this information useful. And if you're not already, make sure you hit the subscribe button because there's like 30% of you that watch my videos that are not subscribed to the channel. So make sure you do that. I appreciate you guys tapping in. My name is Ash. I'll catch you guys next time.